Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Given all the gyrations that the stock market has been making lately, the obvious question on most every investor's mind is, will this bull market survive? So that's the question that we are putting to our panel today. Research Director Shiraz Mian and equity strategists Tracy Reinick and Todd Bunton here to try to help answer that question. And Todd, you say that the bull ball game is in the final innings.
Yeah, and that's over the long stretch. So if you look back to 2009, we've had a tremendous run up in stocks, and a lot of that has been supported by some fundamentals. Okay, stocks were cheap back in 2009, as we all know. But earnings have grown tremendously, and we're actually at record earnings on the S&P 500. But if you look at the pace of earnings growth going forward, that's expected to be very slow because profit margins are at record highs, revenue growth is pretty sluggish. And then on the valuation side, we're no longer cheap. We're not crazy expensive, we're not dot-com levels, but to expect more PE expansion with slower earnings growth is kind of wishful thinking, I think. So I would expect kind of slow, maybe mid-single digit price gains, and this is looking over the next maybe 3 to 5 years, because if you take a look at, if you cyclically adjust the PE ratio, we're kind of in pretty high territory, and that would suggest just kind of more moderate stock prices over the next several years.
Right, single-digit price gains, but gains nonetheless.
Gains nonetheless. Yeah, as long as the economy continues to grow and interest rates stay fairly low, the Fed stays pretty accommodative, I think stocks are still a good place to be, but don't expect those similar returns you've seen over the last 5 years to continue over the next 5.
So then, technically, the bull market ball game is not in its final innings.
Well, yeah,
if you're getting good returns, positive returns, the game still goes on.
I don't know if I'd call that a bull market. I'd call it more flat.
Okay. Well, that's a good clarification point. You're not as optimistic about this.
No, I'm not. No, I'm not. I agree with most of the points that Todd lists. But my concern is that over the last 5-6 years, we have gotten into this mindset that stocks only move in one direction. That they keep moving up, and even when there's a pullback, it's very shallow.
It's a buying opportunity, right?
It's 5 to 7, 10%, and again you jump into the market, and this has certainly been true. You mentioned the fundamentals. Yes, fundamentals have been favorable. The Fed has been extremely supportive, but I think we have reached the end of that. We are finally at a stage where the Fed is reevaluating what it's going to do in the future. And always in the past, when bull runs have ended, they have coincided with the Fed shifting. And the Fed is starting to shift. The earnings picture, you listed it beautifully. It's behind us now. We are getting to the historical trend of low single, mid-single digit growth rates. But I see it very likely that we will drift down over the next 6 months, year and a half, as this uncertainty about the Fed, about the economy, about the earnings picture unfolds. Stocks don't necessarily need to go up. They have, for very long periods of time, drifted down, even in a stable economic environment. So I'm not calling for a recession. Yeah. Or earnings starting to just tumble, but even this kind of benign backdrop would be consistent with the market giving up a fair amount of gains that it has under its belt.
Yeah, Todd, so take that, okay? So Tracy, you say for the bull not to survive, we need at least a 20% correction.
Yeah, I mean, and we've seen that in some of the really hot stocks. They've already pulled back 20%. I somewhat agree with both of my colleagues here, but
as always, you're in the middle.
Yeah, but I don't think it's going to be as easy as, oh, we might just drift down. I mean, we've kind of seen over the last 2 weeks already some panic selling in some of the really hot stocks. So with the kind of bull that we've just had, and people still remember 2008. I hear it all the time from people. Some people still aren't even in this rally because of 2008. So. I don't think it's going to be this kind of nice decline if we get the decline and, a year and a half from now, it'll just be down 10% or something like that. I think it's going to be kind of violent, which we've already seen over the last 2 weeks, and then maybe we wash all that out, and then I think we go into what Todd has said, where it's just kind of, it's not awful, but it's not the kinds of gains we've seen.
But I think there's going to be a lot of winners and losers, okay?
Yes.
And when we talk about the market, I usually use the S&P 500 as a proxy. So yeah, the higher beta, the glamour stocks that soared in
small
2012 and 2013, yeah, the small caps, those have taken a beating, and I expect those to continue taking a beating. It's, you know, the fundamentals got way out of whack with that. But you're seeing rotation into more dividend-paying names, more value-oriented stocks. And if you look, I think it's going to be more of a stock pickers market. So I think you have to pay attention to fundamentals going forward. And I think there can be a lot of winners over the next year, year and a half,
Sure.
even if we have that slope, you know, 10%
Sure.
negative slope here.
Or more.
Or more.
They used to say it's going to be a market of stocks and not a stock market back in my time. So we're in the middle of Q1, not in the middle, but we're in Q1 earnings season, middle approaching here.
That's right.
In the next week. You think this market's going to just continue to gyrate until investors actually see the outcome of what earnings season produces?
I think so, yeah. I think the market needs to finally see the growth that it has been pricing in for a better part of 2 years now. The expectations all along for the outer periods would be very positive. And fairly subdued for the near periods, and we've been seeing that play out for a better part of 2 years now. So what we need to see now is some change on the guidance front, not necessarily a complete reversal that management teams start guiding higher, but at least less negative, or standing behind what the consensus expectation for Q2 at least is. If we start seeing that, that'll probably improve some of the anxiety that we've been seeing lately. If not, I think this problem persists.
All right, so Tracy, in the meantime, diversification is the key here for investors, right?
Yeah, I agree with what Todd was saying, that it will be stock pickers market, and you can't just be in the small caps anymore and expect, you know, to ride to these huge gains. You should have a mixture of everything, because small caps may turn around. That's still where the growth is. But I do think, you know, you should have the mix with the large, maybe some utilities, things that are paying the dividends. And, you know, if you have that broader mix, it won't be as volatile for you.
Okay, and everybody here seems to agree diversification is the key word, right?
Absolutely.
Yeah, in every market, I'd recommend it.
All right, thanks for that. And we are going to be back with their top stock picks, because it's a market of stocks and not a stock market. And that's in our next segment, so click on over.